Cheers, my name is Shaipan, and today I was joined by my colleagues Nathano, Ugrit, and Boksayam. We are Pinnacle partners, and today we're so excited to bring Volkswagen to the Pinnacle. Today, our key objective is to help Volkswagen groups return into that sustained profitability status. And with this key objective in mind, we come up with two key recommendations: build the best and ace your goal, where you can expect to achieve this incredible impact. So to start off, let's look at our company overview. So Volkswagen Group is the second largest car manufacturers in the world. They include the brands like Volkswagen, Audis, Porsches, and Bentley. And the key thing is that they also have a really strong manufacturing sites and also the R&D process. So now, if you look at our current initiatives, our leaders in the Volkswagen Group see that if we really want to survive in the car markets, we need to have the car that have good qualities. Therefore, they want to invest heavily into the car technologies and also the software. But these things requires a lot of investments, which this is the long-term investment, right? So this is the key thing that we really need to consider, and we need to select the right choice or right type of cars for us to invest in order to maximize the money that we spend and the thing that we will get back. So as you can see, mainly in the markets, there's three types of the cars, including BEV, which is like the full electric cars. The second one is the hybrid car, which is the EVs and ICE car combined together, which you can use both electric and oil. The last one is the ICE car, which is the car that uses the oil in order to drive. So now let's see each one specifically. So for the electric cars, nowadays, the trend is really going upwards. So for now, in 2021, there's a 6 million sales of the electric car globally. But in 2024, you see that there's a 17 million of the cars, of the electric car sales. So as you can see, there's an over 300% growth in just 4 years. So now, looking at two more types of car, which including the hybrid and ICE. So for hybrid car, there's a lot of people that use hybrid car. Mostly will be in the countries that still lack of the charging infrastructures, like the EU. And the last one is the ICE cars. So the trend for the car that use oil nowadays is dropping every year. And there's also some politicals nowadays, like wars that increasing the price of the oil, which is supporting the trend that hybrid and ICE car might not be the best option right now if you look in the long term. And therefore, we decide to focus on investing heavily in the BEV car because the trend is supporting us, and yeah, therefore it's the best trend for us to invest in long term, right? So now we already know that we would like to invest heavily in the BEVs. So now let's look at our BEV sales of the Volkswagens nowadays, right? So here Volkswagens mainly sell the cars in three main areas and other areas. So for EUs, the market share is around 38%, for China around 32%, for US around 11%, and others minor countries combined together to 19%. But if you look carefully, China's EV trend sales right now is continuing to increase. So for currently, there might not be the major problem right now. And also, if you want to focus too much on China, there are still a lot of competitors from now. So maybe I think we should build the strong foundations first in order to jump into China. The second one is the US. You can see that there's only 11% of the sales, but the problems in US is significant. So there's some political uncertainties, like Donald Trump's saying some new politicals, like increasing conflicts. Like as you can see from the Joe Biden's, the tariff rate of the electric car from China is 100%. But when you change it to Donald Trump's, it shifts to 145%. So as you can see, there's so many uncertainty things that we cannot predict inside the US. Therefore, we think that focusing in the US areas might not be the best option right now. And lastly, other countries, 19%. The trend is also increased, but the other countries combined together, there's too many countries. And if you want to fix this, we need to fix the infrastructures from each country, which require a lot of our effort and investment and many market research. So for now, we think that by focusing on EU first, like solving the sales decline issue in EU first, might be the suitable options. Because as you can see, during the 2021 to 2023, the sales of EV cars in the EU is still increasing, but there's some drops in 2024. So in order for us to achieve our goals of solving the issues of declining in sales, we need to analyze why the EU sales, EV car sales in EU is reduced. So as you can see, there's two key things that makes people not buy EV cars anymore. So in EU, the manufacturing cost of the electric cars or the electric batteries is really expensive compared to other countries, which in EU, the price of the EV cars around 30,000 euros, which is really expensive if you compare to China or other countries. And our implication is that, and also in the Europes, in these continents, as I just mentioned before, we have the strong infrastructures and the production sites. But now, those production sites doesn't use in full capacities, right? So now we just, as we're doing analysis, we think that to reduce our costs, maybe by leveraging our existing production site or capacity that we have, might be a good way. Because if you leave it right now, it's going to eat your cost without getting anything, right? But maybe if we use our leverage, our production side or capacity that we have, and partner with some other car companies or anything, that might be the best way for us to reduce the cost in some way. And the second problem is the infrastructure problems, because the reasons that most of the people in EU still use the hybrid car or the oil car, because first there's not have sufficient amount of the electric charging side in the EU. So the way to solve this issue is really easy, right? Just use sufficient amount of charging stations. But imagine, by doing that, it requires a lot of investments, right? So our next key question that we need to solve on the thing is that how can we ensure that the investment that we put into the charging stations in EV in order to build the better infrastructure in that place is balanced to the thing that we get in returns. So in order to achieve our goals, we come up with two key questions. So first, which is how can we leverage our existing or the excess production sites first in order to reduce the production cost of the most working groups. And the second key question is that how can we create a better charging infrastructure in EU while still get a reasonable benefits for us with the investment that we put in. And in order to answer these two key questions and achieve our goal, I would like to pass the mic on my strategies to explain about it.
Thank you, Mr. Chayapat, for your analysis. And now let me introduce you to our first strategy, build the base. First, we need to have a look at the trend of EV that is emerging globally. EV has a much lower cost of per charge and the total cost of car. And second, it's much more eco-friendly than other types of cars. And with that said, however, in EU, customers perceive differently from global. Because to EU customers, the hybrid cars are a much cheaper option and a more convenient option. For example, the length of mile that you can use with a hybrid car is approximately 700 to 800 kilometers. However, if we compare this to the electric vehicles, we can only use around 300 kilometers. So that means that we need to have two problems that to solve. First, we need to reduce the cost of our electric cars, and second, we need to prove that their performance is already good. Now, how can we reduce the cost of production? So, Volkswagen has excess production lines in Europe, and in fact, they have announced to allow Chinese car makers to take over those missing lines. So, the capacity has not been fully used, and how are we going to leverage this thing? So we'll be partnering with Renault, a French car maker that produces a car at a much lower cost. Usually cars used in Europe cost around $32,400 US. But what Renault offers is a much lower cost of $27,000 US. And what we'll be offering them is a production capacity. And in order to give, after we give them this production capacity, we'll be offering them a lower cost of production. And with that said, we have already answered the problem of cost. So after we reduce the cost of our production, how can we ensure that the EV will have a better performance to suit our customers? So Volkswagen has a subsidiary called Power COSE that has been located in Germany. So what this company does is produce an EU battery. recently, they have a joint venture with the Ion Way in October 2023 that they have produced a large-scale industrial production of CAM. Now, you might wonder what it is. So CAM is basically a cathode active material that has been used for EU's batteries. So, and PCAM is the precursor that is used in electric cars. So, the more pure these batteries are, the better they will be. So, when we change our production of battery to our powered CO company, we'll be able to give our EV cars a much higher driving range and a better lifespan for our customers, and also increase the safety of our EV cars. As a result of our two strategies, first we will to reduce the cost from $32,400 to $27,000. And next is the performance. Power CO will be able to provide a better type of battery that gives us the better performance of EV cars. And our customers will definitely be satisfied. But with these performance upgrade, how do we communicate to our customers that the performance are already good? So we'll be doing two go-to-market strategies. First, the motor show in Germany. So we'll be showing the performance of our electric car and what it can do, showing the city what our electric car can do. So second is the social media. We'll be doing some advertising on Facebook and Instagram, showing our customers that even though our car is relatively cheaper than before, but it's much better. Let me pass on to my second strategy to elaborate our question.
Thank you, Mr. Nathanon, for your first strategy. Now let's move on to our second strategy, is your goal. So here, we are understanding that currently EV demand are rising by 34% in the Europe. And also, the European Commission have mandated to phase out production of ICE cars by 2035. These incredible facts tells us that EV have a rise in demand in Europe. However, EV are currently very expensive for customers due to battery costs, in which my first strategist has already mentioned this topic. Now let's look at the second topic. The infrastructure in the Europe. Since there are less charging infrastructures, this would cause the customers to be less convinced to actually buy those EV cars. However, we have a really good news. Since recently, there has been a collaboration with XPeng to develop China's largest super-fast charging networks. So basically, our company Volkswagen have partnered with XPeng to create a charging networks of stations in China with the goal of 20,000 charging stations in 420 cities. That's basically 47 stations per city. And in this agreement, they also have the rules that these will be co-branded by the two brands and also operated with both parties. And lastly, these stations will be accessible to customers for both companies. However, since this is done in China, after this successful launch, we would like to do it in Europe with a new brand called Volks Fast Charging. So Volks Fast Charging here is a super fast charging station in Europe, in which we would like to collaborate with XPeng again in the new market of Europe. So what we get from this collaboration is the pain point that we have answered of our customers. And also, we would like to capitalize on EU market, since we will be also considered the first mover in this market. So what XPeng would get from us would be new opportunities, new revenue streams, and also partnership in Europe, leading to EU connections and partnership for the future tasks. And now, let's look at our supply chain. To explain it to you easily, this will be made in China, transported to Europe for the European market. And now, this is our execution strategy. In the first phase, we'll start at home by allocating these stations in major cities of Germany, like Berlin, Wolfsburg, Munich, or Frankfurt, with around 25 stations per city. So that the timeline of this would take around 2 quarters or half a year. And the impact of this first phase would be about revenue streams that would increase, and also we'd like to test the market, like according to those 34% rise in demand, does these stations actually fit those? And also subsidy from governments. Since EU are actually really targeting about green economy, this will also answer those
checkpoints. And now, let's look at the second phase, roam to neighbors. So after allocating in Germany alone in the major cities, let's look at the major cities of our neighboring countries. For example, Brussels, Paris, Lyon, and all of those mentioned here. And the number of stations that we would like to allocate would be around 25 stations per city, but all of this would depend on the population and the area of the city. Because if in a small sized area, there will be more charging stations that wouldn't make sense in the type that one customer will be using too many stations per area. And the impact of this would be our revenue stream again, as it will also increase in a new market, and also opportunities for future experiments. It will be a key lever to expand our method in European nation, and this will also take 2 quarters. Now, after expanding in Germany, in neighboring countries, let's look at further chart our phase 3, which will be allocating stations in the suburban areas of Europe, with both in Germany and EU nations. This would be around 15 stations per city, because we would like to understand that, as we have written, that it depends on the density of people using the vehicles in per city, because suburban areas would have less dense of cars than the cities, right? And moving on to the impacts, this will of course impact the revenue, and also will get the subsidy. We might get the subsidy from the European Union, because we are again prioritizing green economy. And lastly, opportunities for future partnerships. And again, this will also take 2 quarters. So here, let's look at our expected impacts. For our own company, Volkswagen, first, we'll be successfully capitalizing on the EU market, as we are the first mover and also the first initiative to be EU, and also revenue stream that will gain more from expanding more, and also revenue stream from the stations itself. And lastly, we'll be ready for the EU Commission, as I've mentioned that in 2035 they would like to phase out the ICE vehicles. Therefore, we'll be ready for those missions, and also ready for rising demand for EV cars. Let's look at our customers. The expected impact for the customer is that they will get a more developed infrastructure around the continent, and also an EV car option would rise in their mind, because since they have pain points about getting low infrastructure, this will answer their pain points too. And lastly, we'll be ready for a major regulation change, so the customers will be there for the change in 2025. So now, after finishing both of our strategies, let's move on to the financial terms, and I'll leave it to my teammate.
So, shall we look into our finance of our strategy? First, we need to look at our implementation timeline. We have 2 strategies: build the base, is your goal. First, our strategy, build the base, pretty simple. Start with R&D, would take around 1.5 quarters to secure the partnerships, and we will launch the first strategy into the quarter 2 and quarter 3 of the first year. However, we're still doing heavy marketing after then, and so on throughout the year. Now, the next strategy is your goal. More complicated. First, research and developments will take around 2 to 3 quarters to ensure the efficiency of the charging stations, and then we will launch into the third quarter of the first year. Now, there's a next step to this, expand, phase rollout. First, our phase rollout will be first phase rolled out in the 2nd quarter of the first year, and the next phase will be rolled out into the 3rd quarter of the first year, and the 3rd quarter will be rolled out in the 4th quarter of the first year. Now, all of these phases does not occurring at once. It occurs next to each other and in every year. However, we're still doing heavy marketing from then on and so on to the year 2028. Now, let's look at our cost. Our project would cost 16.3 billion USD dollars, and we will generate around 21.7 billion USD dollars. And our revenue was driven by both increase in customers and increase in charging station use.
So now, judges who are ready to take Volkswagen to the Pinnacle with us, Pinnacle partners. Thank you.
Thank you, Team Pinnacle partners. We will now proceed with the Q&A session. Judges, you have 15 minutes for Q&A session.
Thank you for that, Pinnacle. A couple of observations and questions. Firstly, correct me if I'm wrong, you seem to be suggesting that your strategy going forward in terms of your market and your growth is Europe, purely, because you're saying that China, you seem to be saying you're relatively safe there. So I would challenge that as a general observation. Secondly, you seem to be putting, in terms of the infrastructure issue in Europe, and that is the lack of charging stations, for example, you seem to be putting all your eggs in one basket, and that is your 5% equity investment in Xpeng. You seem to be saying that they will help to develop that technology and infrastructure in China, and somehow this 5% partner is going to allow you to export this to Europe, and then you set up this kind of bulk fast charger. I would suggest that's a challenge. I don't know what sort of shareholders agreement you've got there, but for 5%, generally speaking, you can't do very much. So if that's your strategy, you might want to rethink that. And thirdly is, and I've asked this for the previous two groups as well, Volkswagen is not Volkswagen. Volkswagen is a conglomerate of brands. For example, Porsche is in there as well. You didn't mention anything about maybe developing or protecting some of those brands. Porsche is very popular in China, even though they're gas guzzlers, as they say. Rich Chinese people like Porsches, for example, and you didn't actually come and look at the brands. The brands is the strength of Volkswagen, unlike BYD, for example. It's just one brand. So I would suggest you should also look at that as well as a general marketing strategy. And the last point, it's a lot here, sorry, no P&L. I don't know how much money you're going to make out of this. This is a bit of CapEx cost, so you might want to look at your financials in more detail as well. Thank you. There is a kind of, there's more comments, so you want to make comment on my comments. Thank you.
Okay, so first I'll summarize your questions and then I'll let my teammate join in to answer those questions, okay? So first question I believe that I heard is that you were asking about our initiative in the Euro market. You asked us about if our approach the European market is good, and the other one is that you asked us about the partnership with Xpeng. And the last one you asked about the financial feasibility, and I believe that another question would be the purchase in China. Yes, the brand, and for example, purchase in China.
Well, I'm just saying that you didn't pick up on the fact that Volkswagen is a very unique company. It's multi-brand, unlike BYD. So how did you think about that?
Yeah, we really think about that, but like we try to see like in the big pictures first, like what is actually the main problems, right? But in the booklet, they mainly state it's like each type of car model, more than the expected or what happened to each brand inside the Volkswagens. So when we're discussing, we didn't have like insufficient amount of information to do that. But still, also we think that by looking at the big pictures of like this thing might be the best options or the good way for us to doing right now, because the trends is really big, so the BEVs things, right? And I think like by a specific focus on like each brand, right, caps the expected return that we might get. So that's why we choose to go to the big trend.
However, to add on to my teammate, you mentioned about the portfolio of Volkswagen that has brands like Porsche and other assets. So our first strategy is trying to create a better battery for EVs themselves. So this strategy could be implemented in many kinds of brands such as Porsche and others in our portfolio as well, not limited to Volkswagen. So I believe that our strategy could be adapted to the brands within our portfolio.
And also to further add on from my colleague, not only the first strategy, but also the second strategy could be implemented with other brands like Porsche or Lamborghini, because if they decided to move on to EV cars, so they can also use those charging stations for them.
So basically, all of our strategies try to build the strong foundations first before like expand to the specific brand.
So, are you abandoning the ICE car?
For now, like we didn't abandon links, but we choose to like have the so our main objective right now is that we want to invest in like the new type of car, new technologies, right? But for now, we will keep the ICE as the same, and we not try to like expand or like improve the quality of ICE more, because we see the trend that like by 2035 there are like the policies that they want to shift to 100% on like mostly EV cars anyways. So we think that by investing huge amount of monies into ICE car might not be the best option.
And to add on to my colleague, we're not abandoning the gasoline cars. However, we saw an opportunity of EV cars globally. That's why our strategy is decided to expand specifically in the EV segment.
Thank you for your presentation. So, two questions. We want to change the behavior or the belief of the ICEs to become an EV by having some sort of like activities like auto shows, social medias. Is that the one that you think is going to be applicable for the market, or there's another way to actually drive the change of the behavior?
Okay, so the behavior of the customer in the EU market, we are not trying to change that. We can see from our data that these customers in the market already adapting and using more of EVs in the market. However, we can see that there are gaps between the hybrid and the EV in the market. People still using more of the hybrid because there are less infrastructure, less charging station, and the battery is bad, the cost is high, and it's just become illogical for them to purchase an EV car in Europe. That's why we are trying to fix those problems to look into their demands.
And to add on to my colleague, we're not trying to change the behavior of our customers, but we're just trying to change the perception of EV cars to our customers, that they're also an effective technology that we can also use, and also it's more eco-friendly than the gasoline cars.
And regarding building the charging stations, in terms of what could be the financial implication behind the returns of actually on the investment.
Okay, so from our our research, our analysis, we believe that our charging station will incur $1.1 billion in 4 years. So by 2028, we will incur 1.1 billion incremental revenue, and we are going to expect to be spending around $308 million by 2028, and there also be a portion of operational expense that will be incurring in those costs too.
But I think I'm asking about the P&L.
Sure. Okay. Well, the P&L we can see in the appendix right here. This is the total revenue of the charging station, which is around combined it will be around 1.1 billion. And when we see that we will invest 350 million, we can see that we can get around 650 million in total revenue, in total profit across 4 years.
I have a question on you launching the brand under Renault, giving them the capacity. The question is, what if this strategy doesn't work? Renault doesn't agree to it. How do you pivot that strategy? What's your plan? And what brand do you have that would be better or comparable to what your strategy is?
So to restate your question again, you asked about what if Renault does not partner with us, even though we offers the production capacity and trying to reduce the cost of production for them. So as you can see, we have the strength that we're not using our full capacity of our production line in Europe yet. And we believe that with this trend, we can offer this capacity to other types of companies in Europe that can also do the same production with a similar cost to Renault or slightly higher, but we will be able to achieve a lower cost overall.
So, which means you don't plan to introduce a car under your own brand. That's why you have to go with Renault.
Also, Renault will only be doing on the production side, but we'll still be introducing our own cars under our own brands and portfolios.
So when we see that we have already also have the company under our subsidy that also that introduce us to the technology of CAM. That means that we can greatly reduce the cost of making a car, and we believe that in given enough time, our company can use this aspect and our own core competency to create a new brand or a new car that costs much lower. However, Renault here is acting like a catalyst to that, so that we can achieve those costs much faster than us investing and developing the technology ourselves.
I just want to pick up on Bob's point there. Why would Renault, which is a competitor of Volkswagen, partner with you to make you better? I presume that's what you're saying. Renault's a competitor, yes?
Yes.
Why would they help you?
So the company's vision has stated clearly that they are looking forward to partnering with Renault, and we believe that with that initiative, so currently they're trying to partner with Renault. So and with that said, we agree that this partnership would benefit them in the future.
As I've been stating before, to add on to my colleague, we can see that our production capability could be used for them because as we all know that Renault is relatively a small car manufacturer company, which means that if given that we given capacities and cost reduction opportunities for them, it is very attractive for them to join us.
You say on one of the slides that you would see the major change of the regulations. What are those, and in terms of the implication towards the benefits of the business? What would it look like?
So here we could see that European Commission have mandated to phase out production of ICE cars by 2035. So the key implication here is that we can see that in the future there will be a rise in demand for EV cars for sure. So therefore, in order to answer those rises, we came up with these, our two strategies in order to answer those future demands.